All right. Today is Monday, September 13th. This is a recap of the stock market activities today. What happened to you guys? I had a lot of faith in you. The Fed had a lot of faith in you. The oligarchs over at Wall Street had a lot of faith in you. Goldman Sachs, BlackRock, all of these rulers had a lot of faith in you. And you have disappointed us. Why? Because you're not buying the dip anymore. What happened to you guys? You gotta continue to buy the dip so the rich can dump on your little head. What's going on here? Instead of buying the dip, you guys are buying puts now, and you want to hedge your portfolio. What's wrong with you? You want to hedge your portfolio. Hedging is for losers. In this hyper bubble mania market, we put our blindfolds on, we got Papa Jerome behind us, and we buy random call options, random stocks, buy first, ask questions later. Matter of fact, don't ask questions at all. But this is not what you guys are doing. You guys are actually asking me how to hedge. Here's a viewer asking, how do I hedge if I have tech stocks? If there is a crash, do I buy the SQQs? Do I buy calls in the SQQs? Yes, you can, but you have to look at your portfolio. Which tech stocks are you overweight in? Are you overweight in chip stocks, software, big cap technology stocks? Which one? Because here are some ideas for you. You can buy puts on the TQQs, which is a leverage index for the NASDAQ. You can buy calls on the SQQs, which is an inverse index for the NASDAQ. You can go old school and buy puts on the QQQs. You can buy puts on the XLK, the technology ETF. You can buy puts on the SMH, the semiconductor ETF. You can buy puts on the IGVs, the software ETF. Or if you don't have any taxation concerns, you can take profits off the table, or you can sell calls, upside calls, covered calls to raise some cash. All of these are hedging strategies. And of course, it is a smart strategy to start hedging now. September, October, these are bad months for the stock market historically. On top of that, we have the prospects of tapering. We have taxes about to go higher. So you can buy these options for September or all the way to October. You can formulate your own strategy. But what I would say is, look at your portfolio. Is it overweight big cap technology stocks? Is it overweight chip stocks? Is it overweight software stocks? Because when it comes to chips, for example, I'm not so bearish on chips because they have a significant price advantage in this massive shortage. Another note is shop around. Let's say you have a diversified technology portfolio. Shop around for these put options or call options on the SQQs and see which price makes sense to you. You can do Greeks analysis, but that will take a lot of time, and by the time you're finished, the Greeks have already changed. So unless you have a sophisticated program that can calculate the Greeks in real time, just eyeball it. The Fed is eyeballing inflation. Eyeball all of these options. Puts on the QQQs, puts on the XLK, calls on the SQQQs, perhaps puts on individual names that you own. Do that analysis and you will find out which one is suitable for you, which one is a better deal for you. And therefore, I say shop around. And before we move on, we have a good one for you. We're going to talk about uranium. We're going to talk about the Litecoin incident with Walmart. We're going to talk about market manipulation via options, and we have seen that in real time in Tesla's stock today. And a reminder, we're going to have another video coming out this evening. We're going to go over the PPI, the ruling against the iMob, Apple. Oh, and by the way, the role of organized crime when it comes to inflation. Yep, the mafia is causing inflation to rise higher. But before we do that, let's see how the market closed today. And here we go. The Dow Industrial Average closing in the green by 261.91 points, or a gain of 0.76%. The Nasdaq closing in the red, down by 9.91 points, or a decline of 0.07%. The S&P 500 closing in the green by 10.15 points, or a decline of 0.23%. You can see the contrast right away. The weakness is in the NASDAQ, specifically the high multiple names. Meanwhile, the inflation stocks, value stocks managed to outperform today, and therefore you're seeing the Dow and the S&P 500 outperforming the NASDAQ. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, energy. At number 2 for the silver, financials. And at number 3 for the bronze, REITs. The laggards of the day led by healthcare, the only sector of the market closing in the red. We also saw weakness in technology and consumer cyclicals, yet both of them closing in the green slightly. What about the advance to decline ratio? The NYSE 64% advancing versus 33% declining. The Nasdaq 49% advancing versus 48% declining. All in all, not a bad breadth for the market, but the outperformance came from the inflation side of the market, not the growth and momentum side. Moving on to futures, what's going on here? The dollar was stable all day long. Not a major movement whatsoever. Perhaps the dollar is waiting for the CPI number tomorrow. But the action was in energy. Natural gas continues to rally, a massive daily gain of about 5% for natural gas. Now, I had a short trade for nat gas, but it's not working so far. And perhaps the trade is losing the thesis, which was an expectation of a resistance around the $5, which was the previous high in 2019. But natural gas continues to blast higher, so this will be a challenging one. Yes, the technicals are overextended, overstretched, but the fundamentals are very supportive for natural gas to continue to rise higher. So I'll give it one more day. If it doesn't work, I will close the short trade for nat gas. Oh, and by the way, we have an analysis from Bank of America that suggests oil prices will go to 100 before the end of the year. A potential of 36% gains from here. And of course, we're seeing the WTI closing in the green with gains of over 1%. The WTI is trading at about $70 a piece now. When we talk about transitory inflation, if energy prices continue to rise higher, Mr. Powell, it is starting to look like the 70s now. What about grains? Massive gains for oats, rising higher. We like oats. Likewise, gains for canola, soybean meal, rough rice, and soybean oil futures pretty much on the flat line with modest gains. The declines are coming from corn, wheat, and soybean futures. What about meats? Losses across the board, lean hogs, feeder cattle, live cattle, all closing in the red. What about metals? Palladium, we talked about that one. The losses continue for palladium. Likewise, we're seeing a pullback for copper today, along with silver. Meanwhile, platinum on the flat line. Likewise, gold on the flat line, but closing modestly in the green. Metals are waiting for the move from the US dollar, which will come perhaps tomorrow as we get the CPI number. What about softs? We have gains for OJ, cocoa, and sugar futures. Meanwhile, losses led by cotton, coffee, and lumber futures. Now, I want to talk about uranium because recently the retail crowd, and I say that sarcastically by the way, the retail crowd has amassed interest in uranium, the Wall Street bettors and the likes. Perhaps one of the more intelligent bets from Wall Street bets when you compare it to AMC and the garbage they've been pumping before. Because nuclear energy is actually the green energy, but it has the stigma of Chernobyl and Fukushima, etc., etc. Even though all in all, nuclear energy is green and also safe. The retail crowd is playing the uranium ride via CCG, the ticker, CCG. Now, I have played this one before. The pump that we got earlier in the year for uranium, I played it via UEC, the ticker UEC. But perhaps the run in uranium caught a lot of attention, and this is a sign that the run is coming to an end. When we look at the chart of UEC, Uranium Energy Corporation, we have a resistance level around 3.65. But again, remember, if the momentum is so strong and the fundamentals are supportive, we could see a scenario like natural gas, where prior resistance is not respected, and we see the rally extended beyond the resistance. That all depends on the momentum. And so far, the volume is large, but we saw a massive pullback here from the highs in UEC. So I'm watching this one closely. Of course, I missed the second rally, the more recent rally, but I caught the earlier one. The uranium trade remains extremely interesting to me, and I will be following how will this one develops. Is it just a pump and dump, or is it more sustainable? Moving on to the big casino, the options market. What's going on here? The hottest table today is Apple, with about 1.1 million contracts traded today. About 64% of those were calls. Apple has a massive problem after the court's ruling. But we have the streaming event, whatever the hell that is, where Tim Apple produces a video and pretends to be James Bond and all that stupidity. For what? They're going to announce what? a new color, another shade of purple. This company has ceased to innovate long time ago. But again, this will stoke some optimism that perhaps we will see a rebound in Apple tomorrow. Now, a highly ominous scenario will happen if we see sell the rumor, sell the news for Apple, meaning after the event, we see a sell-off in Apple, perhaps accelerating the sell-off that already started last week. This will be an ominous signal for Apple and for the market in general, because if the market says we're not impressed by the new products, and oh, by the way, this is a distraction from the court's ruling, which pretty much can eliminate your highest margin business, the shakedown business, the mob business of going after app developers for 30% of their revenue, which is, of course, an illegal racketeering operation by the iMob. But don't expect the judge to say any of that, because the judge herself is invested in Apple. She owns Apple stock. How is she going to rule against the iMob and crush her own retirement? How will any politician in the country rule against Apple or regulate against Apple when they know this will hurt their retirement accounts? Tesla, number 2, with about 800,000 contracts, about 53% of those were calls. Now we have the obligatory Tesla pump on Mondays. Every Monday we have an entity, quote unquote, that pumps Tesla on Mondays and then dumps by the end of the week. Of course, they have a lot of catching up today because Tesla traded down in the morning and they've been buying these 750 calls aggressively. And we know that once these calls double in value, they're going to dump right away. This is the criminal behavior that goes on in the stock market in this unregulated jungle pretty much every single day. And it has been going on for decades and decades and decades because they have decided in the 1980s to sterilize the SEC. And we knew all along that we have a sterilized SEC that goes after small fishes, you and I, not the big ones. Once in a while, when we have a crash, a disaster, they have to go after a scapegoat, and last time around it was Madoff. But Madoff was the small fish in the pond. Now the SEC has evolved from a sterilized organization to a dormant organization in a coma. We have this unregulated jungle of a market, pumps and dumps all over the place. And this was evident today by Tesla, and perhaps even more evident by the action in Litecoin. And you might remember, by the way, a few days ago, we talked about the put options trades on Twitter. The highly unusual trades on Twitter, buying puts aggressively so. And now we got the news that Goldman Sachs is issuing a downgrade for Twitter. Somebody knew ahead of time and they have initiated the put options trade. Is the SEC going to do anything about it? Of course not. For all you know, perhaps this trade was initiated by Gary Gensler himself. Perhaps the guy is trading on his Robinhood account on the side. And this is not new, by the way. I know what you're going to say. Bro, what's up with the conspiracy theories? How about you stick to the data? Yada, yada, yada. I want to talk about conspiracy theories since we just went over the 20th anniversary of 9/11. Remember this? Data shows heavy airline stock short selling. The date is September 22nd, 2001, and they're referring to trades that happened before the day of the disaster. Matter of fact, the University of Illinois conducted a study on the unusual options market activities leading to the attacks in 2001. I'm just going to read for you a little bit here, but you can read the research on your own. Many observers maintain that AMR and UAL, this is United Airlines, AMR used to exist back in the day. Option activity leading up to September 11 constitutes strong evidence that there had been trading on advanced knowledge of the attacks. For example, on September 19th, the CBS Evening News reported that September 10, AMR put trading exceeded the call trading to such an extent that its sources had, quote-unquote, never seen that kind of imbalance before. And the September 6 put and call trading on UAL was extremely imbalanced, quote-unquote. And here is the conclusion of the research, and they went over a lot of details here. The paper concludes that there is evidence of unusual option market activity in the days leading up to September 11 that is consistent with investors trading on advanced knowledge of the attacks. Ta-da! Back to the options market. The third hottest table in the casino today was AMC, with about 650,000 contracts. About 71% of those were calls. And pay attention to the ticker MO. This is tobacco. And we have About 96% of the options traded for this name were calls. What does that mean? Usually it means that the stock is about to dump. It's a contrarian indicator. And I tweeted about MO today, saying perhaps we will see some weakness in the name in the days to come. And this is, by the way, based on a reliable pattern that goes back for a few quarters. Simply put, you see the icons, the D and E in the chart. D means dividend day, E means earnings day. So what you do is you dump on dividend day and you buy on earnings day. And if you did that, as you can see, it's a profitable strategy. Now, why are we seeing such behavior in this stock? The reason is nobody's interested in buying the stock, in actually investing in the stock. They're interested in catching the dividend. The stock has over 7% dividend. So what they do is they buy the dips on earnings all the way to the dividend paying day. On that day, when they cash in the dividend, they dump right away. Here comes another dip, and as we get closer to earnings, they buy the stock again, lather, rinse, repeat. So once again, D, you sell, E, you buy. We will see if this pattern continues or not. But the bet here in buying MO puts is based on a reliable pattern that goes back for a few quarters. Moving on to the unusual activities that took place in the options market today, starting with the ticker ATR. Now, we have caught this trade on this program before it happened, and it's a massive squeeze. The stock was up, I believe, over 50% at some point today, and it continues to be one of the hottest names in the options market, and we have bits all over the place. But pay attention here. I'm highlighting two trades, one for puts, the other one is for calls. The put trade is short dated. The long trade expires in October. Now, what does that mean? It means that options traders are expecting a pullback, some profit taking, and then the stock will rebound or resume the rally once again. So we're going to go over the put options trade because it is the immediate one. In this case, they bought the $15 puts with the expiration date of September 17th, meaning this upcoming Friday, with the expectations that the name will pull back to about 12% or more by Friday, and they paid about $1.50 a piece to enter this trade. All in all, spending about $1.5 million. Here is a trade for the XOP, the oil and gas ETF. We have calls that energy prices, oil prices in particular, will go to 100 at some point, perhaps by October, and therefore we're having a bet here, a spread. Somebody's buying the 92 calls, yet they're selling the 105 calls. It's an intelligent trade, by the way, all for the expiration date of October 15th, with the expectations that the XOP, the oil ETF, will gain anywhere from about 5 to 21%, not more than 21%, because that's the ceiling for the trade. Any gains above 21%, they're not going to be able to capture that, and the reason is they sold the 105 calls. Now, it cost them $2 a piece for the 92 leg, the long leg. Meanwhile, they received about 50 cents a piece in credit for selling the 105 calls. All in all, the entry cost is reduced to $1.50 a piece, and that brings the total to about $1.2 million. What about the trade for the ticker SPY, the S&P 500? They're buying protection now, specifically the 415 puts with the expiration date of October 4th, with the expectations that the name could drop down by more than 7%. They paid about $1.75 a piece to enter this trade. All in all, spending about $1.3 million. What about the trade for the ticker CPRY, Capri Holdings? We have a bullish bet here by buying the 57.5 calls with the expiration date of November 19th, with the expectations that the name will rise higher by more than 6% by then. They paid about $3.20 a piece to enter this trade. All in all, spending about $2 million. Lastly, what about the trades for the ticker AMC? We have a call spread here. AMC is rising higher today, and I believe it closed above the milestone of 52 that I was eyeing. So somebody's betting for more gains to come here. Yet they're being very disciplined with buying a spread instead of naked calls. They bought the 56 calls and they sold the 58 calls for the expiration date of this upcoming Friday, September 17th, with expectations that AMC will rise higher by about 8 to 12%. But not more than 12%. That's the ceiling for the profitability in this trade. They paid about $1.40 a piece for the 56 calls that they bought, and they collected about $1 a piece for the 58 calls that they sold. All in all, the entry cost for this trade is reduced to 40 cents a piece. All in all, they spent about $250,000, aka a quarter of $1,000,000. So the entry cost is 40 cents a piece, but the profitability, the maximum profitability of the trade is about $2. So you could triple, a little more than triple your investment if this trade works. And if not, you lose the 40 cents a piece, the entry cost, which was about $250,000. I'm assuming this trader has millions and millions of dollars, and this is just a small trade for them. Moving on to the heat map analysis. What's going on here? As you can see, the inflation trade is outperforming today, significantly so. Whether we're talking about financials, energy, industrials, mixed, but still outperforming. Materials is also outperforming. What's not outperforming? We have healthcare. This is the sector of the market with the highest divergence from the 100 days moving average, meaning that profits will be taken from that sector. Likewise, the high growth, high momentum names within the technology sector also not performing at all. Meanwhile, we have chip stocks outperforming, and chips are considered inflationary. Chips are considered offensive, specifically the old school chips. Forget about NVIDIA, AMD, the high multiple ones. Stick to the old school ones. AMAT, Lam, perhaps ADI, Analog Devices, Texas, Qualcomm. These are the kind of names that will withstand any storm in the technology sector of the market. They will fare better than NVIDIA, AMD, the software names, the high multiple, high growth kind of names. Another stock that got shot today is Nike, down about 2.5%. We have a downgrade, and the concern is regarding inflation and perhaps the supply chain bottlenecks. I would add on top of that perhaps the upcoming Chinese crackdown on American companies, because we have yet another crackdown against Alibaba, and Alibaba's trading down. At some point, you got to ask the question, when does it stop? Are they going to delist these companies from the market altogether? Because at some point, a lot of traders, a lot of investors have been buying the dip in these Chinese names, and they've been getting hammered, catching a falling knife. And today we have even more restrictions from the Chinese Communist Party. In the morning, they said that China has too many electric vehicle companies. And of course, NIO, Li Auto, Xpeng did not react today, but who knows what will happen in these stocks in the future. When they say we have too many companies, do you want one nationalized company, for example? China is going back to the communist roots. But perhaps some good news, Chinese bank executives investigated, arrested amid tightened crackdown on corruption. Perhaps if we have crackdown on corruption here and we have bankers on handcuffs, we're not going to have all of these problems. So again, the Chinese Communist Party has a lot of wrongdoing, but they're also doing something good for the Chinese people. It's a mixed bag, but it will impact these stocks tremendously, and I would say negatively so, specifically if the expectations are we're going to delist these stocks from the US market. And again, we heard some news regarding Tencent, WeChat, Alipay. All of these apps will have to share customers' information with the government, pretty much. I'm just cutting to the chase here. So the saga of the Chinese crackdown is not over yet, and this will impact Chinese stocks for now, but perhaps we have the big shoe to drop when the Chinese Communist Party decides to crack down on American companies in China. Moving on to charts, what's going on here? We talked about multiple scenarios last night. Among them, a gap higher in the morning that is quickly sold off. And this is exactly what happened today. And this is an ideal bearish scenario because it emphasizes the change from buy the dip to sell the rip. Now we have the CPI coming out tomorrow. We have the event from the IMOB coming out tomorrow. And therefore, we have some short covering at the end. But don't kid yourself here. The action we saw today is negative. It's bearish. We have a pop in the morning that gets sold off. Sell the rip. This is not a good sentiment for the stock market to continue to rise higher. It's a change in sentiment. And by the way, look at the first candle of the day. Where did it stop? To the penny, to the line I showed and shared with you last night. You think this is a coincidence? Or it's a perhaps, or maybes, or could have been? No. There are no coincidences here. The market and the algos know exactly what they're doing looking at these numbers. And you have me to show you these numbers. We have 447 for now to look at for the resistance. It'll be interesting to see how the SPY trades once it reaches 447. We have somewhat of oversold conditions here from an intraday basis, which could merit a technical bounce. We'll see how long will it last. This is the chart for the continuous contract on the SPY, a daily chart. We're pretty much back at the trend line to the penny, and now we're waiting and waiting and watching how the SPY and the market will react. Will it bounce from the trend line? And if that is the case, then we have a garden variety pullback. But if it pierces below the trend line and it pierces below 4,384.5, we got a massive problem here. Looking at the momentum indicators, we have weakening, obviously. When we look at the volume, we have an elevated volume today. But when we zoom in, we look under the hood, where did that volume come from? Did it come from buying or did it come from selling? And the answer is selling. What does that mean? The power is in the hands of bears right now. And by the way, look at the bounce to the penny of the trend line. Amazing. This is a 30 minutes chart for the Qs, the triple Qs, the NASDAQ. Again, gapping higher in the morning, only to be sold off, failing to capture 378.45 as support once again. Can the Qs give it another shot tomorrow? Yes, it can, because we have somewhat of oversold conditions from an intraday basis that can merit a pop higher. On top of that, we have the CPI, the CPI. We know the cooks will be busy. On top of that, we have Apple, the iMob with the event. All of these catalysts could merit the NASDAQ to pop higher and give it another shot at 378.45. We'll see how it does. This is a daily chart for the continuous contract on the NASDAQ. We have a doji from a candlestick pattern. What does that mean? It means indecision, but it also means that we have a massive move coming up ahead, up or down. We will look at the momentum indicators. They're weakening, but from strength, from extreme strength. Also, the volume is not rising higher as we've seen with the SPY. My reading is institutionals, market participants are hesitant to dump their big cap technology stocks, the Apples, the Googles, the Facebooks, the Microsofts, and that's pretty much it, right? The four big ones. But at some point, if the sell-off continues, if the weakness continues, if the CPI comes out hot, then at some point the straw will break the camel's back and these institutions will start dumping their technology stocks. And that will produce the 10% correction in the NASDAQ that we've been talking about. 30 minutes chart for the IWM, the Russell 2000. What's going on here for small caps? Doing a little better than the SPY and the NASDAQ. It is battling the resistance of 223. We have an outperformance from the cyclical side of the market, the inflation / value / reopening, and this is good for the IWM. On top of that, we have AMC outperforming today, along with a lot of other meme stocks. The GME, GameStop, is not included in the IWM anymore. GME, believe it or not, plays in the big league, but GME was also trading higher today. Dixie, what's going on here? Going all the way to the resistance of 93, facing the resistance and taking a dive down, retreating to gather energy before it pops higher once again. But hold your horses here. It will all depend on what the CPI number will be. If it's too cool, which is the job that the cooks have to do, serve us a cold meal, and if they do that correctly with no f***ups this time around, then the dollar should ease, as tapering concerns also ease. And the opposite is true. Gold, what's going on here? Not liking gold. We have a bear flag here. Again, it's waiting and waiting and waiting for the dollar. The dollar is waiting and waiting and waiting for the CPI, and everybody's waiting on somebody else. But my reading here, gold is the mature guy in the room. And when gold is waiting and having a bearish formation, perhaps gold is saying that the dollar is about to pop higher. Because gold has another enemy, by the way, which is the 10-year yield. And that was down today slightly, not by a lot, but that did not motivate gold to rally higher. So what's up here? Gold is smelling something. Gold is seeing something, and it's being extremely suspicious. Now, when it comes to yields, we have tested and retested 1.28% for support. It looks as a solid support, a solid flooring for now, but it will all depend once again on the CPI. TLT, weekly chart, and a weekly candle, they come together in one package. The weekly candle looking a lot better, popping above 149. Again, the TLT has been consolidating over and over again. The bond market hasn't been moving for weeks and weeks and weeks because it is waiting for more clarity regarding tapering. And that clarity will come out when we get more inflation data and more employment data in particular. Apple, weekly chart. We're not looking at the 30 minutes chart today, and the reason is we know that the resistance is 150, the support is 145. But this is a weekly chart, and we have weakening in the momentum. We're about to lose momentum here, and the likelihood is if Apple flushes down, goodbye market. We're going to see a correction in the market, perhaps a severe one, if Apple goes down all the way to 140, 135 to retouch and retest the lower band of the channel. Tesla, the souffle. We talked about the manipulation, the pumps via buying call options aggressively, but we also know that whoever is doing this is interested in pumping and dumping quickly, making gains on Monday, dumping by Wednesday, Thursday, Friday at the most, in, out, hello, goodbye. On top of that, the pattern has been broken. We have a lower low, so you can pump this all you want. It can't fool us at all. If anything, this is an opportunity to short for those who missed on shorting the chart. Now, when do we know that we're wrong and Tesla perhaps bottomed and it will continue to go higher? If the chart reaches 750 and it continues to go higher and higher and higher, 760, 765 at the most, and you'll know right away this is more than just a pump and dump because the pumper is buying 750. On a Monday, they're already sitting on gains. So if the stock moves higher, perhaps to 760, they will be sitting on significant gains, and that will prompt them to dump right away. Now, another important note that could change the patterns that we're used to is Friday's options expiration. We have the monthly options expiration date, September 17th. So keep that in mind, that certain patterns will not work out due to the monthly options expiration, and it will be an important one, by the way. We'll talk as we get closer to Friday. VIX, what's going on here? The pop is still intact. It produced about 30% gains. The VIX is trading below 20 this time around, but the pop in the MACD seems to be intact for now. Some weakness, but once it crosses, creating red impressions in the histogram, then we'll know it's over, and the SPY will perhaps start to rally higher again. BTC, what's going on here? We had some funny business in the morning, and it impacted cryptos, including BTC, by the way. In the morning, we had an announcement from Walmart, it appeared so, that they're adapting Litecoin, which is garbage, by the way. I knew it was fugazi. It was bullshit because why would Walmart buy a tulip? They have their own flower department. But anyhow, a lot of traders were fooled. We saw a massive pump in Litecoin followed by a massive dump. Why? Because Walmart pretty much denied any association with Litecoin or any cryptos. So this was a pump and dump right away. Some criminal somewhere did the pump, cashed in, and left a lot of traders holding the bag. And the tulip market is looking very shaky here. Lots of problems. We have Coinbase now dumping. They just IPO'd and now they're dumping $1.5 billion. What's going on here? But rest assured, we have BlackRock, and BlackRock is saying cryptocurrencies are a durable asset class with real upside. Y'all, you think now? Here's the problem, folks. The pump and dump scheme that we saw today will impact cryptos negatively because we're going to have more scrutiny now from the SEC, and the sentiment will sour that the crypto market is unregulated, and we have a lot of problems, a lot of criminal activities, a lot of predatory activities in the crypto market. And this will impact BTC, Doge, Ethereum, everything. I would say BTC will go to 42,000, and if that doesn't hold, the likelihood is it will not hold after what we saw today. We have a bear flag pattern, and the likelihood is BTC will flush down. The action today was extremely bad for any crypto enthusiasts. It shakes the faith out of the crypto market, specifically those who are not, let's say, in a cult, perhaps mom and pop investors, some institutional investors who decided to buy cryptos on the side to test the waters, see how it goes. They're going to dump right away. Moving on to AMC. What's going on here? Remember this tweet when I suggested buying AMC off the support of 42.5 because it has been retested over and over and over again. Well, if you did buy AMC back then, we have gains of about 24%, 24.5%. I think this is enough. It's good enough for me. You take profits, you get the hell out of this one. Even though AMC traded slightly above 52 today, above the resistance line that I was eyeing. But for me, for my taste, this is enough. I'm not going to take the shot, roll the dice further. If it trades above 52, have at it, but I'm taking my gorilla suit off. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the CPI, the most important one. So let's preview the CPI. Here are the components, and I'm eyeing, by the way, the month-over-month increase or decrease. I could care less about the base effects year over year. That means nothing to me. I look at month over month, and when we look at food, for example, the PPI report showed a massive increase in food prices, so my expectations are food prices will go higher month over month. Now, what about energy? We know we saw a massive dip in August for energy prices. My expectations are the month over month will show a decrease in energy prices, but this will be misleading because energy prices rebounded higher right away. Now, what about gas and utilities? You know what's going on with natural gas. The expectations are prices will move higher month over month. Now, what about vehicles? New vehicles, my expectations are they're going to be more expensive due to the scarcity. But what about used cars? We saw a massive dip month over month in used cars prices, but they remain elevated year over year. The expectations are it's really difficult to predict, but we knew right away that used cars prices will be transitory. And from the indicators that we have right now, we know that used cars prices went down slightly in the month of August, and therefore the expectations are we will see a dip month over month in used car prices. What about apparel? My expectations are apparel prices will go higher. This is at least according to the PPI report and the manufacturing indices that we got in the past. Likewise, when it comes to medical care and medical services, we have seen prices decreasing from other indicators before. So the expectations are these numbers should come down month over month. Now, here's the tricky part. Shelter, aka rent. Rents have been surging across the country. Is that going to show up in the August report, or will it show up in September, October, November after the evictions moratorium expires? We will see. Likewise, from the PPI, we know that transportation costs, prices have risen dramatically month over month in August. So my expectations are we will see the cost of transportations rising higher month over month. Where does that leave us, by the way, in the overall picture for the CPI? The number doesn't matter, by the way, and here's why. If used car prices go down month over month in a dramatic way, you will see the corporate news media, CNBC, and the Fed having the biggest orgasm in the planet. And the reason is they will assume, look at used car prices. They went higher and then they went down. And therefore, every inflation that you see around you will end up the same way as lumber and used cars. We know this is baloney. This is garbage. So long as the Fed continues to print, inflation will rise higher. Inflation has always been a monetary phenomenon. On top of that, consumer inflation expectations are at the highest reading since 2013. And when it comes to inflation, the psychology and expectations matter more than the garbage numbers from the CPI. And now we have the casino, the bettors, betting that the Fed will not taper in next week's meeting. So the assumption for now in the market that the Fed will not taper and that the upcoming CPI number will affirm. That's a good stock, by the way. Not today, but it was good stock for a while. But they will affirm their outlook of no tapering. We'll see. Another concern we have to pay attention to in the next few days is the prospects of tax increases. We have no details yet. It's vague, but the end result is your taxes will go higher. 1,000,000% guaranteed. Why? Because we have trillions and trillions of dollars in budget deficit. Somebody got to pay for that. It's not going to come out of the pockets of Wall Street. It's not going to come out of the pockets of Apple, the I-mob, because the I-mob stashes the money over in Ireland where it's been doubling year over year over year over year. So it's going to come out of your pocket. Yep, the poor and the middle class. And now they're proposing a new taxation regime, increases in taxes for capital gains, assuming that everybody that trades the stock market is rich and wealthy. But we have a community of traders, regular folks, regular people, assuming a lot of risk, trading the market, investing in the market to make a living and make an income. They will be punished if capital gains taxes go higher dramatically, indiscriminately across the board. I hope that the Biden administration will be able to differentiate between the whales, the 1%, and regular traders that assume a lot of risk to trade the market. Matter of fact, capital gains taxes should be reduced or eliminated under a certain income. Why? Because you need traders, you need investors, you need retail traders and investors to keep this market alive. Anyhow, folks, this is all I got for you for now, but I will talk to you again soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.